What's up? What's up? What's up, everybody?
Hi,
Jorge, how's it
Tony,
going?
Latino Wall Street. Hi, everyone.
Good,
How's
man.
everyone
Good.
doing
Good to see
today?
you.
Good to
Another
see
day in
you.
the
Good to see
office.
you. Excited for this presentation. Thank you for the opportunity.
Yeah, no, thank you for coming out to New York. I mean, we had such a blast out in New York City at the Titans Mastermind, and there was such an interest from your presentation, and a lot of our students and people from our community were coming to us and saying, "Oh my God, this is great, but my husband or my wife is here with me, and she doesn't speak English, or she only speaks English. Can we redo this presentation in English?" And you told me, hey, you know what? I actually do this presentation in English. Usually, I had to translate it for Latino Wall Street. So
That's right.
I'd love to
Yeah.
have you rerun it. And yeah, we're going to be talking about multifamilies, real estate, investing. We saw this week gold hitting record highs. And when you have really strong gold like what we have now, that means you have a weak dollar. And that means that you want to be diversifying and looking at assets and ways to protect your wealth and grow it and create passive income. So I'm really excited for this conversation about real estate and multifamily investments. I think it's a really important conversation. And I'm excited that we're able to do it here on Zoom. So we're going to be able to take questions from people at the end and really get people some guidance on this important topic.
Yeah, absolutely, absolutely. I mean, this is one of my favorite topics to discuss. We use different strategies here at KPI Capital Partners when it comes to investing in real estate. This is just one of the many different strategies that we use. And just a quick recap, just from when I did the presentation in New York, one of the things that I equated it to is that for someone that's accustomed to investing in the stock market, right, this is very similar, because what are you doing when you're investing in the stock market? You're buying shares of a company. Whatever that company does, if they make widgets or they do this or that, the other, you're still basically buying shares of that company and benefiting from the revenue that's created from that company's business function. Well, it's no different here. When you're investing into a multifamily syndication, that's exactly what you're doing. You're buying shares of the entity, of the company that owns, in this case, we're not making widgets, we're owning and operating a large scale multifamily property that's generating revenue on a monthly basis. And what's our product? Our product is housing. Our product is something that everybody needs. We all need a roof over our heads. We all need a clean, comfortable, safe place to come home to rest our head. And that's what we're doing. We're providing this type of value to the community, where we're also generating not only ourselves, but our investors, our shareholders are benefiting from that. And on top of that, we get the little added bonus of the tax benefit, which of course I think it's everybody's favorite part. So we'll get into all of these details as we move on with the presentation.
Yeah, well, I'd like to say, it's not about how much money you make, it's about how much money you keep. And that real estate tax strategy is really, really advantageous to protecting your wealth and your income and keeping more of your money. I want to give Uncle Sam his cut, but not a penny more.
That's it. That's right.
So yeah, let's
right.
dive into
All right,
it.
well,
You have
let's
the
jump right
PowerPoint?
into it. You have the presentation ready to go?
Yeah.
So we're about to go, we're going to share our screen. We'll start with the presentation. I like to be dynamic, so I hope you guys don't mind. I might stand up and kind of move around a little bit. I think the camera will follow me around, but I hope it's not too distracting. If it is, I'll sit back down. I'll do my best to stay still. But I like to be dynamic when I do my presentations, just to keep it interesting. You ready to go?
Yeah, I'm open.
Okay, give us 1 second, guys. It's just getting it ready here.
Yeah, no worries. And I know you just got back from Dubai. How was that?
Oh, it was an amazing trip. Yeah, I was there for about a week. For those of you who don't know, so we have our main office here in Miami. We also have an office in Dubai. We're diversified in the private equity space. We're also invest in data centers and in the energy sector and a few other things. And we have some very, very strong contacts in Dubai with some large family office and private equity firms that manage sovereign funds and big things that we're doing on the data center side. So it's just, it's all about diversification and being able to provide these type of opportunities to, especially to our Hispanic community, but just, to our community in general. So.
Well, yeah, I know. I that was the interesting thing when we first got together and had the conversation about doing the New York event. And then we also have coming up at the end of the month a Miami event that we're going to do together
Yeah,
on
we're
the
going to bring you
30th.
guys
But
to our community. You invited us to yours, and then you're coming into ours through. We have an event series called Capital Insights. Obviously, pun on our name, KPI Capital Partners. And so we'd like to provide as much value to our community as possible. So we're very excited to have you, Tony, and Gabby coming and providing value from your perspective to our investor community as well. So it's a very synergistic.
I'm excited. It's a great partnership, but when we were first talking about doing events together, I remember you saying like, "Hey, I'm having this big impact, and you're, the child of immigrants, right? Colombian, Latino American, but a lot of your clients they're actually not Hispanic. You have a lot of clients who are, white and Jewish and Muslim and all different walks of life, but not so much of an impact in the Hispanic community, and that's why I'm excited for this partnership, because it kind of comes full circle, right? You went to college, you went to university, you studied, and you're kind of like the epitome of like the American dream, and for you to kind of come back full circle and share your knowledge and your wisdom with our community. I just wanted to say how grateful and thankful that we are.
Yeah, that was a passion project of mine that over the course of the last 2 years, I really focused on bringing a lot of this information to the Hispanic community, which, wasn't really readily available for some reason. There's always a little bit of lag in information when it comes to Hispanic communities. I'm sure you found the same when you brought, the stock and, investments, Wall Street investments to our Latin community. And so I wanted to do the same thing from the real estate side because I was raised here. I was born in Colombia, but I grew up here. I went to school here, university here, law school here. And so my whole network was basically the American market primarily. And so about a little over 2 years ago, I set off to bring the same information to our Hispanic community. And now, thankfully, we've been able to really grow that as well. So.
Very cool.
But
all right, let's jump into it.
Should we get the conversation started? Okay, go to the next. So again, everyone, nice to meet everyone. For those of you that don't know me, my name is Jorge Fajardo. Go back to this. My name is Jorge Fajardo, or just keep it to the main page first. Founder and CEO of KPI Capital Partners. I founded this company about 10 years ago. I've been in the industry for over 20 years. And, today we're going to be talking about building wealth through multifamily syndications, which is, again, one of several different strategies that we use here at KPI Capital Partners to create wealth through real estate. Before we get started, go to the next note. So just, a little bit of housekeeping disclaimer. Basically, all the information that we'll be providing here today is for educational purposes only. It's not meant to be financial advice or legal advice. Again, it's just solely for educational purposes. Go. Okay. So a little bit about our company. As I mentioned, I founded this company back in 2015. Our parent company, which is Keystone Property Investments. Since then, we've expanded into different verticals, different markets. But when I started this company, I started with literally $1,000 investment, and we have been able to now grow into a 9-figure portfolio, AUM, which is our assets under management. It's one of the things, Tony, when you interviewed me on your show on the Florida New York Stock Exchange, I talked a little bit about our first deal, how I was able to do that using some creative financing and investment strategies in the real estate space. Now we've grown into a real estate private equity firm with one of our specialties being the multifamily syndication strategy. When it comes to this strategy, our focus area is in finding what we call value add opportunities where we're able to reposition the property and stabilize it and then produce the forced appreciation and increase the value. And that's how we make our money, which we'll get into all of that. We're focused on creating strategic partnerships in order to be able to grow and scale. I can tell you that through one of these partnerships, I mean, we've literally almost doubled our AUM just from one relationship, where we're now buying over 1,000 units, 1,000 doors with just one partnership that we've been able to acquire through our philosophy and the value that we'd like to bring to the table. And again, our portfolio on the real estate side spans from multifamily properties, large scale multifamily properties. I'm talking about 300 units, 600 unit, 400 unit, entire apartment complexes, to single family development, luxury, ultra luxury development projects, vacation rentals. So we have a diversified portfolio, and we do have a proven track record, long-standing record with strong investor returns. And again, a little bit about me. I was born in Colombia, Barranquilla, Colombia. Like I said, I founded this company back in 2015. Overall, I have over 23 years of experience in the real estate space across different facets of it. I've been a lender. I've represented clients through loss mitigation and foreclosure defense. And I've since then gone back into the finance side of it, which is originally, that was my background, was in finance. I eventually went on to get my law degree, and through the 2008 downturn, we were able to help a lot of people avoid foreclosure and save their homes and their credit, and really be able to help from a consumer advocacy, consumer defense standpoint, which ultimately, what we want to do is be able to create value. So I took my banking knowledge from 2002 up to 2008, and then I pivoted to help the people that were losing their homes. And then from there, I pivoted into the company. So again, we're experts in multifamily syndications, deal structuring, creative finance strategies. I also do mentor. I'm a speaker at many wealth conferences around the world. I've spoken in conferences throughout the United States, in Dubai. Been invited to speak in conferences in France and other places. And again, we're all about, private equity, venture capital investments. We're also in the energy space. So we're very well diversified, just to name a few. And then once I started focusing on the Hispanic market, I've been fortunate enough now where I'm a regular contributor, financial contributor in Univision and Telemundo, several both Spanish and English speaking publications, where I've been able to really, I think, fulfill my calling, which was to really provide this information to our community. So before we get started, this is something that I honestly live by. This is a quote. It's not my quote, but something that I read once and it really stuck with me. It's by unnamed, but really, the true cause of anything isn't the money that we pay for it, but it's really the time of our life that we traded to earn that money. So think about that, right? Because, we have been ingrained in us, through our childhood as we grow up, you have to work, make money, make a living, get your education, get a great job. But really what we're doing while we're going through all of that is we're trading our time for money, right? So as an example, right, if we're buying a $200 pair of shoes and we're making, $20 an hour, that pair of shoes just cost me, 10 hours of my life, So when you think of it like that, it really puts things into perspective. And so that's why my whole philosophy in life has been, okay, making that switch of, instead of me working for the money, I've learned and trained myself on how to make my money work for me. Because my money doesn't get tired, my money doesn't sleep. And if it's working for me, it's working for me 24/7. Whereas if I'm working for my money, even if I work 24 hours a day, there's always going to be a ceiling, right? At some point, we got to spend time with our family, our loved ones. We have to rest. We have to enjoy our times. We have to enjoy our lives, right? It's not just about working 24 hours a day. So that's where true wealth is created, when you change that paradigm in your mind, where you start to create wealth by making your money work for you. So I really do live by this quote. It's something that I hope that you take to heart if anything else you take away from this presentation, this is something that I truly believe in. All right, so multifamily syndication, right? What is a multifamily syndication? The simplest way to put it is that a multifamily syndication is a way for a group of investors who come together and they pool their capital to buy a larger apartment building, a big apartment complex, right? These multifamily communities that we see when you're driving around, right? Where it's going to be generally too expensive for one individual to buy. So any of you who have ever driven around your town, your neighborhood, your city, and you see these large scale apartment complexes, right? You ever wonder to yourself, you know, we've all maybe even lived in them, right? Where there's multiple buildings, 5, 6, 10, 15, 20 buildings within the same complex. And you're wondering, who owns this, right? We just go in, we go to the leasing office, we do our paperwork, and then, you know, we rent our place, and that's it, right? And then we live in there. But have you ever thought about who owns these places? And a lot of times it used to be that it was only owned by these huge private equity firms, these large, you know, institutional investors. And, you know, the reality is that times have changed, and through multifamily syndications, you know, a group of people, regular people, everyday people like us, we're able to now acquire these types of properties. And I'll give you a little preview right now before I get into the, you know, what we're going to talk about. But there's going to be a case study at the end. Some of you who maybe have seen the presentation when I did it in Spanish in New York, you'll see that we're going to do a real life case study of a project, a property that we're in the process of actually acquiring as we speak, which is a 324 unit large scale multifamily. And this property is massive. It's a total of 19 buildings, and it takes up the equivalent of entire like four city square blocks. I mean, this thing is massive. And so we're going to show that as one of our case study, real life case study that we're working on right now. But, you know, as we go through it, we're going to talk about the actual concept of what is a multifamily syndication. We're going to talk about the roles of the individuals within that group that comes together as a syndication, how it works, also why investors, or what investors like about it. Why do investors like it so much? There's a lot of benefits that come from owning real estate, as we all know, especially with our current administration in place, with the big, beautiful bill that passed. So we're going to talk about some of the benefits. And then, of course, the reason we all invest, right? What are the typical returns, right? We're investing, you know, not only for money, we like to invest for other things, social impact and you know, affecting our communities when it comes to the real estate side of it. But at the end of the day, you know, we're stewards of our capital, and we want to make sure that we see a return from every dollar that we put in. How many more dollars can we get coming back? So we're going to talk about that as well. Go to the next one. So at the simplest level, okay, this is an illustration of how a multifamily syndication works. Okay, we're buying the whole building, which, by the way, one of our mottos here is why buy one unit when you can buy the entire building, right? So that's the other thing that, you know, over time, from a mindset standpoint, I've trained myself to really think big, to think on a large scale, right? And so this is one of the ways to do it. So the typical structure for a syndication when we're buying a large scale property like this, it's basically a limited partnership, where on one side you have the GP, the general partner, and then on the other side you have the LPs, right, the limited partners. So I'll start off with the GPs first, and then I'll go on to the limited partners. So the general partner in the syndication, in this case, otherwise known as the operator, which in this case, let's say would be us. So we're the lead sponsor, the GP, we're the operator, the ones that actually basically handles everything. We underwrite the property, we underwrite the market. We're the ones that go out and qualify for a 5, 10, 20, $30 million loan, right? Based on our expertise, based on our track record, based on our experience. So we put together the entire business plan. Because remember what I said, whenever you're investing in a multifamily syndication, you're buying shares into the entity, right, that is operating the business. So in this case, if you're investing in Tesla, right, their business is creating electric cars, right, among other things. But simplified, right? Well, in this case, when you're investing into one of our multifamily syndications, you're buying shares into the entity that's operating a 300 or 600 unit multifamily property, right? Which at that point, it almost transitions more from real estate into a business, right? And so as the operator, as a GP, we're the CEOs of that company. We're the executive suite of that company, the CEO, the CFO, the COO that are running this company that happens to be operating, our business happens to be operating this investment property. Okay, so that's where we contribute our expertise. We're also putting up our own capital as well. Okay, and we all split in, obviously the equity and the fees and everything like that. But what's important to note is also that when it comes to these type of investments, we're putting up capital as well. So it's really more of a co-invest, because when someone's buying shares, we're also investing, and we're usually the ones putting up the majority of the capital between our own equity and our financing or funding sources. Okay, so that's the general partner, right? The ones that are running the company. Then the limited partners, in this case, which basically the majority of you on this call would fall into, this is the shareholders. Okay, easiest way to equate it, no difference. So you're contributing your capital to the extent of the number of shares that you're looking to acquire into the company that's operating the business, which is the property. And then depending on your share size, that you're receiving equity and dividends, that it's pro rata, prorated to your share size. Okay, and so the beauty of it is that as a limited partner, your risk is completely limited only to the amount of investment you made into it. So if there's an issue with the property itself, what it has to do with insurance, liability, the 10, 20, $30 million loan that we took out to, as part of the acquisition on the property, you're not responsible for any of that. Okay, so you're isolated, insulated from all of that, where you don't have to worry about your exposure to risk, your exposure if someone gets hurt on the property and they sue the company. You don't have any exposure and liability to that. So you're only participating in the investment that you made, and then you're receiving your distributions, your equity distributions, and your dividends based on the amount of shares that you have. So it's a really beautiful structure, because we're able to you're transferring the risk onto us as the operators, and we're taking on all that responsibility to making sure that we execute the business plan and maximize the returns. So at the simplest level, this is the structure for your standard multifamily syndication. Go to the next one. Okay. Now, how does a multifamily syndication work? Okay. So we're going to go through all of these. I see a question there, Anna. Do you want me to answer the questions as we go if I see them pop up, or you want me to kind of leave it for the end, Tony? I saw someone else. So typically I'll answer it quick, and then you tell me what you want me to do. But
yeah, I mean,
if quarterly dividends.
Yeah, if it's part of, if it doesn't mess up your flow, if it's related, then you could address it, or if not, we leave them for the end.
Yeah. Okay. Yeah. So I'll answer it real briefly.
Yes. So Anna asked, how often are the dividends distributed, and how much per share?
Well, so it always depends on your product. Everything is proportionate to your investments. Okay, and we'll kind of get into that. But the distribution schedule is typically a quarterly dividend. So you're participating in the quarterly dividend of the net operating income of the property, and the best part is you're also participating in the equity when the value is increased, which is called in multifamily, it's called forced appreciation, because we'll get into that a little bit more. But the value of a multifamily property is not based on an appraisal, like how you appraise your home and then you're looking at what your neighbor sold for. The true value of a multifamily property is based on the net operating income. So the more we can increase the rents, the higher we can push the value, and that's called forced appreciation. So we're not depending on, we don't care what the neighbors are doing. We don't care if the multifamily next door is mismanagement and they're not fully occupied, or they're not renting to market rents or anything like that, because it's not affecting us directly, as long as we're executing our plan and we're operating the property and as efficiently as possible and maximizing the profits. But we'll get into all of that in more detail, but just quick answer is dividends are distributed quarterly. And so we're going to talk about obviously the overview of what a syndication is. We're going to go into more detail, number 2 here, on the partnership structure, the GPLP structure, the capital stack. You heard me say, some of it is our own capital, some of it is debt financing, and then some of it is equity investment from the shareholders. So we're going to talk about all that. Cash flow distributions. Anna, to your question, we're going to talk about that in detail. How we execute the business plan. Because again, when we're looking at it at this scale, this isn't, when you buy a rental, you're not really, you are executing a business plan, but typically we don't look at it that way. We're just, okay, we're operating a rental property. But this is more a large scale business. So we have a business plan in place that has to be executed in order to achieve the goals that we're trying to achieve with that property. With any investments, we got to have an exit strategy. And in most cases, not only one, we have multiple exit strategies, plan A, plan B, potentially plan C, and maybe a contingency, because, we have to be prepared for anything that comes along. And then, of course, we're going to talk again about the investor benefits. So this is just a quick overview.
Can I ask something just quickly?
Yes.
So the average amount of doors in one of these multifamily deals that you are investing into, what is the average amount of tenants? Just like a round number, it doesn't have to be exact. But.
Well, I'll give you an example. So we've scaled into this, right? So when I first got into, I started in the single family space, and we were doing about 40 single families a year that I was buying. I wanted to get into more, large scale projects. I started buying multifamily, but small scale multifamily, 10 doors here, 18 doors there, a 20 unit, another, 12 unit. So that's what, now I'll give you the scale of what we're buying. I mean, right now we're under contract. We're buying a 324 unit in Ohio. We're buying a 682 unit in Oklahoma. We're looking at another 450 unit in Ohio also? No,
Houston, Texas.
In Texas. 450 unit in Texas. We're looking at a 68 unit. We just put an offer today on a baby 68 unit this one is in Ohio, in Cleveland, 68 unit in Ohio. So it goes towards what I was talking about mindset before, right? And kind of like expanding your sort of like your limiting beliefs. Where before I used to think that a 10 unit or a 20 unit was this massive deal. And now we look at a 68 unit as like a baby deal. It's all about, how when your mind really starts to expand and you really start to sort of, grow out of your comfort zone, how the way you look at things change, right? And your perspective changes. So it's hard to say, but if I had to give it an average, what, 300? 300 to 400 is what we're looking at. A few years ago, our average would have been, 20 doors per unit, per property. So it's like how things, economies of scale and how things grow. And so why do we like multifamily properties? Number one, the demand is essential demand. And the way that I like to describe it is this is about as recession proof as it's going to get, because we all need a place to live. Right. And when the economy is good, the people that are living in apartments right now, they're renting apartments, maybe they get a raise, they get a better job. Now they can qualify. Now they go out and buy a home of their dreams, right? Their first home, maybe, because they're coming up from the rental time. And now they're buying a home and, everything's great. The people that are maybe in low income housing now are able to come up and go into a little more, a better area, more stabilized area, what we call a class. We tend to classify areas, class A area, class B, class C, and then class D. So maybe someone that's in a class C area, living in affordable housing or section A housing or something, maybe they want to move up into, a nice class B area, better neighborhood, even though they're still renting in a nice, beautiful apartment complex that has nicer amenities, a better pool, dog park, whatever the case may be. So that's the area that we try to be in, that middle area. In a down market, like we saw in 2008, where I was helping all these people save their homes or at least avoid foreclosure, where a lot of them who had to maybe eventually leave their home, they're going from maybe, their nice home or where I do, but now they still want to live in a nice apartment complex or a nice apartment. Well, now they're coming down. So we're catching that market as well in a downturn, right? Because the people are downsizing, they're downsizing from a house, doesn't mean that they're going to go live, in a low income area, maybe they just want a nice apartment complex that they want to live in. So this is where we sit, somewhere in this middle area. In an up market, we catch the people ascending, going to a better life. In a down market, we're there to still provide a beautiful, safe, clean, healthy living environment for anybody, regardless whether you're coming up or maybe whether you're downsizing. And so that's why the demand is always going to be there, because we all need a roof over our heads. The reason also we like multifamily, because of the cash flow, the stability aspect of it, which is part of what I just talked about, the forced appreciation, which is what I talked about a minute ago, which is we control our own destiny. We know where we can push the value to. We're not depending on market conditions. We're not depending on whether the neighbor sold their house for, more or less than what they were supposed to, or anything like that. We're controlling our own destiny. So based on our business plan that we have in place before we even buy the property, before we go into it, we already have a business plan in place. We've already done all the market studies, all the demographics, all the underwriting. We know what we can project this property to increase to. And so that's a huge benefit of multifamily syndications, is the ability that we have the ability to force the appreciation by our actions. Scalability, of course, as I just mentioned, a few years ago, we were buying 20, 30 units. Now we're buying 300, 400, 600 units. So scalability, right? That's a huge thing about it. And then, of course, everybody's favorite thing, tax advantages. Anytime you own real estate, and this goes to whether you own your own home, rental properties, rental units, there's huge tax advantages to owning real estate. And through a multifamily syndication, you benefit from all of those same advantages because you are an owner. By being a shareholder, you are an owner of that property. You can put that on your portfolio. It's going to be in your balance sheet. You're going to receive a K-1 at the end of the year, and you're going to be able to benefit from all the tax benefits as well. And then, of course, as I mentioned before, strong exits, because we take an undervalued property that's being mismanaged, underoccupied. They're just not doing something, the most efficient way to operate it. We'll come in and we'll increase the value. And then once we have it, we're buy here, sell here. Again, stock market, right? So we want to be able to take advantage of that. And so that's the beauty of it. We have an exit strategy, just like when any other company, let's say, you get bought out or you go public, you have an exit strategy. That's the case here. We always have a 3 to 7 year, on average a 5-year exit strategy that we know already going in that we're going to buy it at this price, but in year 5, we're going to exit at this price and we're going to cash out. And all of our shareholders are going to be able to cash in on that as well, because they're going to get their shares of that forced appreciation while they were receiving dividends the entire way all the way through. So you have multiple streams of income as an investor. Okay, so the typical returns that we see, there's multiple streams of income, as I was saying. Number one, you're getting the cash flow, okay, and that comes in, like I mentioned, the forms of dividends. There's different types of equity positions depending on the strategy. We have, preferred pref equity. We have common equity. Same thing as like pref stock, common stock. Same thing. We just use the word equity instead of stock in real estate, but it's basically the same concept. You're getting total annualized returns, which is a combination of all the dividends that you receive plus your exit over the life of the entire investment. The way we look at it, we quantify it in equity multiples. Okay, so like for example, the case study you're going to see, we have it underwritten as a 2.81x equity multiple. What does that mean? That means that we're buying the property at this price, and as long as we execute the business plan as we project, we're going to be able to sell that property at a 2.81x multiple. In other words, almost 3x. So it's almost like we're buying here, we're selling here at 3 times what we bought it for. Okay, and that's part of that forced appreciation. So that's how we equate it at a quick glance. This is a 2x multiple, a 2.5 multiple, a 3x multiple. And so that's how we quantify what the projection is. And then, when it comes to the profit splits, there's like a waterfall method, which basically is just, okay, how do we distribute based on everyone's shares? Who's got pref equity, who's got common equity, and all these different structures, which may vary from on a case-by-case basis. but it's just one of the ways that distributions are also, or profits are also distributed. Okay, and then also as a typical return of investor benefits, this kind of falls more onto the tax benefits and the savings, because as you were saying, Tony, right, we can make all these returns, but if we got to give 50% of it back through capital gains, then what do we really do here, right? We just made the money to then just give it to Uncle Sam. We want to make the money and keep a bunch of it in our pocket, and that's what our goal is by applying a lot of the different benefits that come as a result of owning real estate. This is another one of my philosophies, and I think this goes to the point that you made, Tony, where when it comes to money, to finances, okay, it's our job to create money, okay? And I purposely use the word create because we don't make money. Make money means that you're going out and you're exchanging your time for money, okay? And that's a ceiling. We create money. So when I'm talking to you guys and I'm saying we're forcing appreciation, we're creating money. How am I turning $15 million, a property that I'm buying for $15 million, to set up for $45 million in 3 years by executing a business plan? Because we're creating that value. We're creating. So when you create value, money follows. It's created. So I always say you create money by virtue of creating value. So number one, you got to create it, okay? And this is how wealth is made. But then once you've created it, now you got to protect it, okay? So how do you protect it? You protect it in many ways. You protect it through sound strategies, through sound deal structure, through sound, tax strategies, how to keep as much of your money as possible. So you're creating it. Now you got to protect it. That's the keeping it part, right? And then the third component is now I want to multiply it. So, okay, so what system, what process do I have in place? I've created it, I've protected it, and now I want to multiply it. So I want to repeat that system. And that's why you see this as an infinite cycle, because you just got to continue repeating the cycle. And quite frankly, that's how I've been able to, when people ask me, well, how did you turn, $1,000 investment, now you have a 9-figure portfolio, is by applying this principle. Obviously, there's details and nuance in the process, but it was always about creating it, protecting it, multiplying it, and repeating and repeating and repeating. And that's where you get the power of not only compounding interest, but compounding effort, and you just keep growing and growing and growing it. And this is one of my core philosophies in life. All right. So we've talked about the different ways that you can make money. And now I want to talk about how we save money, right? How we protect it, how we keep it, right? And one of the things that we do, and for those of you taking notes, we're going to talk about more about this, but if you want to do some of your own research, cost segregation study or cost segregation analysis is one of the best strategies to save money on a property. Okay, you can even do this on any of you that own your own home, or you have a rental property, whether you have one, whether you have a few, more than one, you can actually go out and do this on your property. And it's what we do on these large scale investments. Go to the next one. So what is a cost segregation study? Okay, so a cost segregation study is used by multifamily syndicators and any other owner of real estate to accelerate depreciation deductions on a property, on any given property. So instead of treating the entire apartment building as one single long-term asset, so on average, if you look at the tax code, you could take a single asset, like as a property, and you can, basically you have to depreciate it over 27 years, 27 and a half years. So whatever your depreciation is, you're going to be depreciating little by little each year for 27 years. However, when you do a cost segregation analysis, a CA, it breaks the property into different components. And by law, under the tax code, different components of the building can be depreciated a lot faster, where you can basically do it all within a way shorter period of time. And I'm going to give you an example so you can see an illustration exactly how this works. But the CSA, the cost segregation analysis, breaks the property into different components. like the flooring, the cabinets, the lighting, the landscaping, the parking lots. All of this can be depreciated over shorter time spans. So 5 years versus 27 years, which makes it a lot more of a depreciation in a much shorter period of time. So I'm going to give you an exact example so you can see it. Okay, but when we're talking about why it matters in multifamily syndications, is because you're able to collect your tax benefits at the very beginning. And it actually improves your returns because you're not having to give half of your returns over to capital gains. And of course, increases the cash flow. So it works all together, all in one. So look, here's an example, okay? So let's say we buy a property for $10 million, okay? And we just do the standard depreciation model over the 27.5 years. Simply just divide 10 million divided by 27.5 years. That gives you, we're able to deduct $363,000 per year in deductions. Okay, not terrible. But if you look at it the other way, okay, if you can take 3 million worth of components that can be depreciated much faster, this could mean that you could create an extra $1 million in deductions within the first year. So would you rather deduct in year one 363,000 or $1 million? Think about that. What would you rather deduct? So if you're making $1 million profit, would you rather deduct off of that million profit you made 363,000, or do you want to deduct $1 million? Right. So now you made $1 million and you deduct $1 million. Now you just made $1 million tax free. That's the logic. That's the idea behind it. So you're basically offsetting what you make from the deduction, and now you're basically making tax-free returns. That's what it basically amounts to. And the way that that's possible, okay, because we just saw the return of 100% bonus depreciation. Okay, how many of you know about the big beautiful bill that was just recently passed? Okay, and 100% bonus depreciation. So in July, as many of us know, the big beautiful bill was enacted. And specifically, what we're talking about in this case is IRC section 168, okay, the bonus depreciation provision, which basically states that it was amended to permanently restore, because we used to have it, it got away, now we got it back, restore 100% bonus depreciation for a qualified property acquired in place of service after January 19. Okay, and so number one, multifamily properties fall under the category of qualified properties. Okay, which means that we can immediately start expensing the qualified production property. So what this means is that, I'll give you an example. Right now, the properties that we're trying to buy, we're trying to close on all these properties before December 31st of this year. Because the minute we close on it, we already have the teams of accountants on standby to do the cost segregation analysis, so we can apply our accelerated depreciation for 2025 and apply the 100% bonus depreciation. And it's funny because at this time of year, this always happens. We have investors that want to come into our investments because they care more about the tax deduction than the actual returns, which, if you can believe that. So there's a lot of people that come into our different syndications and different opportunities towards the end of the year because they really are focusing more on trying to get that deduction than anything else, which I think it's, I think it's great.
It's genius.
Go to the next one. Okay, so I think someone asked who can participate, so we're going to get into that. So how can someone participate into one of our syndications? So there's two categories of investors, and I can confidently say that everybody on this call can fall into one of these two categories with no problem. So the first one is sophisticated investor. A sophisticated investor, as it states here, is simply an individual with financial knowledge and expertise who can evaluate investment risks and opportunities, even if they don't meet the accredited requirements. Which we'll get into the accredited. The accredited requirement is more about your size of your income and your net worth and that kind of thing. So depending on how we register a particular offering, within the SEC code. In some cases, we can work with sophisticated investors where they don't have to be worth a certain amount in order to qualify to invest with us. They just simply have to have just a general knowledge of financial investments, and by virtue of being members of Latino Wall Street, you guys are all at the very least sophisticated investors. That is by definition 100% the case. Now, an accredited investor is someone that it sees here as an individual, an entity that has to meet the SEC legal definition, legal requirements, which means that you have to have an annual income over 200,000 as an individual, or if you're with your spouse, over 300,000. Okay, or you have to have a net worth exceeding $1 million. Okay, without counting your primary residence. So if you have other investments, whether stocks, rental properties, other things like that, if you exceed $1 million, you're also a accredited investor. Or if you have certain other entities like a company, a partnership, trust, that also qualifies towards your accreditation. What is the difference? So from our perspective, depending on what section of the SEC code we register a particular offer, then we can only work with accredited investors. So I'll give you an example. If we want to keep an offer private, which is for the most part what we usually like to do, at least at the beginning, we register it as a private offering. Then when we're registered as a private offering, we can work with sophisticated investors and accredited investors, because it's basically word of mouth. It's where I'm talking to groups like you, and this is considered a private setting, right? If I register it as a public offering, where now I can go and market it through social media and advertise returns and try to really just talk to strangers and really publicize it. I put it out on the radio, commercial on TV, and really make it public. Then once I do that under the SEC regulation, then at that point I can only work with accredited investors. So we try to keep it private because we like to provide and give this opportunity to as many people as possible initially. So if we don't have to advertise it, if we don't have to market it to fulfill or subscribe the offer, then I'd rather keep it private. And for the most part, like 99%,
It's mostly private.
Mostly private, because anytime we put out an offer, we already have, remember guys, we already have 80 to 90% of the capital stack already covered, because we already have those relationships in place. So when we offer up the shares, we're only really looking to fulfill 10% of the total. And so it makes it much easier to keep it private and allow this opportunity for as many people as possible that honestly wouldn't otherwise have access to an opportunity like this if we register it as a public offering, which is a lot of times what you see where, it used to be that only the institutional, the big guys had access to this type of deals and these type of returns, where now we're opening it up to like I said at the very beginning, to everyday people just like us. The next one. So this is the difference of the registration that I was talking about. So for registration and compliance purposes, we operate under SEC Regulation D. So we call it Reg D. So we're a Reg D offering. Okay, within that, there's two specific sections. There's Rule 506B and Rule 506C. So if you remember when I was talking about the private offerings where we can open it up to the sophisticated investors and just everyday people, that would be 506B, which allows you issuers to raise unlimited capital, okay, but I can only accept up to 35 non-accredited but sophisticated investors. So usually we don't fill more than, maybe a hand, like 10, 12 people. So we don't ever hit the 35 mark. But we can do general solicitation. We can advertise, okay? And, as the investors, I basically could just take your word and you say, yeah, I'm sophisticated, yeah, I'm accredited. I take your word for it, right? I don't have to verify it. Now, if I want to make it public and I register in the 506C, okay, I can still raise unlimited capital, but now I can only have accredited investors in the fund or in that project. And the accreditation has to be verified. For example, I need to get a certified letter from your accountant. I don't need to look at your financials. I don't need to look at your tax returns. I'm not your mortgage broker. I don't need to look at your bank statements, but I do need a letter for compliance purposes that I need to have in file. I need to get a letter from your accountant certified that says that yes, your accountant certifies that you're an accredited investor, that you meet those requirements in that definition that we saw. You make at least 200,000, you have $1 million in net worth, you have trusts, other property, so on and so forth. So whatever the component of that, your accountant.
What's the minimum usually to get into these types of deals?
So it varies. So it could be as low as 100,000. In some cases, it could be a minimum of 500,000. So these are bigger deals, but typically it's around 100,000. Is the minimum per investor. Now we have other deals. This is on the multifamily space. In other strategies that we used in different deals, it could be as low as 50,000. In some cases, we made exceptions and maybe dropped it to like between 30 to 50 in different types of deals. This is where, remember, when we started the conversation, this is one of several strategies that we use. So when I say we have a 9-figure portfolio of assets under management, that's a combination across the board of different projects, larger, smaller, different strategies. Some are short-term, some are long-term. So this is what I would consider more of a long-term because it's a 5-year commitment typically, where we have other strategies that are, let's say, like 1 year or less, where it's structured a little bit different, but then also the minimum investment is also a little bit less. So it's just different strategies, different opportunities, because we try to, it's not one size fits all, so we try to have different opportunities for different types of investors. Today, we're just talking about this one strategy in particular.
Got it.
Okay, so, well, before I go, does anybody have any questions regarding the regulation, the SEC code, or anything like that, besides Tony's question before we go into the case study? No? Okay.
How long does it take to acquire the first
Yeah, you
property?
got some questions.
Oh, do we? Okay.
I mean, good afternoon. What is the minimum starting amount? Okay, we answered. And then good afternoon, same from Maria. What is the minimum to start and how long does it take to acquire the first profit from the investment? So I think first dividend.
Yeah.
I think that's what she means.
So, but we only start raising for the property, pretty much once we already have it secured, we've already gone through due diligence and we're ready to close on it. This case study right here, we've been negotiating this deal for like almost 6 months.
Yeah.
But we finally got it under contract. We immediately had, I think, 45 days for due diligence.
Yeah.
We're just about to come out of our due diligence next week, and then we have to close in less than 30 days after that. So in this one, we basically have over 90% of the capital stack already secured. We're still accepting investors. So this is, and I'm going to give you this is the actual case study of a total of $21 million acquisition, which includes everything. We've already covered 20 million of it. We still have 1 more million to go. And so we can actually open this up to investors at a minimum of 100.
Are you also getting money from the bank?
Yeah, that's part of our capital stack. That's part of our capital stack.
Like
So
debt, in-house investors, and then retail investors.
and then the equity investors. Right. Exactly.
Then the bank. The bank is your business partner.
So the bank goes first, and then we have a family office that comes in and covers the majority of the equity side. And then we only just have to raise, like I said, the small portion of it. So this allows us to open it up to individuals. So let's say in this case, we're raising $1 million, whether we have 10 individuals at 100, 5 at 200 or 2 at 500, whatever the case may be. Once we hit the $1 million, that's it. We're capped out.
Why do you open it up to individuals? Why not just raise the money from family offices and keep it moving?
Oh, we do both. So for example, right now in this one, we have actually 2 family offices that want to come in for that $1 million, just one entity coming in for that $1 million. And so it just really, like I said, it's like kind of like it's about what I said before, right? Like opening up these opportunities for everyday regular people, right? It's a little bit more of I'm not gonna say, how do I frame it? So it's more work for us, you know, in terms from the accounting side, compliance side, and everything like that. But that was the point, right? To be able to open this up to people. But you know, at the same time, we are already have verbal commitments from a few that are willing to just come in and cover the full million. We're kind of holding them off. Maybe we'll come back and say we get a couple individuals, and then we'll say, look, we only need 500 from you, or 700 or 800. And that, because I do really want to, my goal is to provide these opportunities to people.
So the question I'm getting from Veronica and Don Hernandez is about ROI. So what would the ROI be on $100,000 investment?
Well,
Like,
it varies on a case by case
annual
basis.
return.
It varies on a case by case basis, but you're going to see that right now in this case study. So
Okay,
let's
so
go
this
to the case
Ohio,
study. You're going to see the
so
numbers.
with this one, okay,
Yeah.
so this is a real property.
Real
It's
property.
in Ohio.
Yes.
It's 324 doors. So 300 people are paying rent. This is kind of what I wanted to touch on earlier. So like in this example, you got 300 people paying your rent. So even if one person stops paying the rent, it really doesn't change the mathematics that much. You're not going to go bankrupt versus if you bought one single family and you have one tenant in there, or even if it's let's say it's a two-family house, yeah, a duplex. You have two tenants, one moves out, you lose half your income, you know. And if you're relying on that cash flow to pay the mortgage on the debt, you know, it could completely bankrupt you. Where in this, a lot of the risk is spread out over these 300 units. And then imagine if you were trying to manage this yourself and you had 300 people calling you every single time the heat doesn't work, the air conditioning doesn't work, right? It would just be a nightmare.
Yeah.
So
look,
yeah, that's great.
That's an excellent point. It's what we call economies of scale, right? So I mean, we stress test when we underwrite a file. I mean, we can afford having, you know, 30 units vacant and still be at, you know, 90% occupancy. You know what I mean? And so for us, this is one of the main things we look at. You touched on another interesting point. So as an operator, remember, we're managing multiple of these properties. So as an operator, what we do is we bring in professional, you know, management companies, not, you know, some realtor down the street, but I'm talking about professional management companies that are vetted and have the track record of managing this type of large scale properties. This is the one that I was mentioning. That's the 324 units. There's a total of 19 buildings, just like the ones you see in this picture, but 19 of them taking up 4 square city blocks in Cleveland, Ohio. Go to the next.
Like a small city.
Yeah, it really is. It really is.
And so, Vanessa says hi. And before we dive into the case study, Marco is asking, can non-U.S. residents invest? Is that a requirement? Does that matter?
No, it doesn't matter. Non-U.S. investors can invest. Just to give you an idea, right now we have investors from 4 different continents. Obviously, United States and Canada. We have investors from South America. We have investors from Europe, specifically Spain and Italy. We have investors from Dubai and Israel in the Middle East. So I mean, we have investors from literally from all over the world that invest into different opportunities. Because remember, we also have an office in Dubai as well, so we bring investors from everywhere.
Very cool.
I'm gonna come back to this. I just want to give you guys so you understand the scope of what it takes to underwrite one of these. So this is just, go to the next one. This is good. So this is just a screenshot of one of the tabs on our underwriting balance sheet.
Zoom in for a sec.
Yeah.
Is it up? Oh.
Yeah. So this just kind of gives you an idea. I mean, our underwriting model, just to give an idea, is what is it? 47 tabs, I think I want to say. Like 47, 48 tabs that all, you know, are cross, you know, basically verified. Go to the next one. Just to give you an idea, I mean, this is what we're looking at when we're doing our projections and running our numbers, and this is how we're determining what the returns are going to be on any particular property, on any particular deal. Go to the next one. Lower it because I need to be able to see it, zoom out. Yeah, so that, okay, that's everything. Okay.
It's a little delayed.
All right. Oh, there's a delay. Okay. So we'll go back. Leave this for this one. So this is just what we call the CapEx, Meaning the CapEx, meaning like what we need to do to fix up the units to what we're saying, reposition and stabilize. Basically, like, you know how if any of you here do a fix and flip on a single family, this is what the CapEx is on this. It's just we're doing it for 324 units, every common area, every exterior, roofs, everything, plumbing, electrical. So in this particular property, if you notice, it's 324. You see at the top left, 324 units, 19 buildings altogether. It's a 1968 build, okay? A lot of work has been done to it already since when we're buying it, but we're still, go to the bottom. This is just our estimate. We're basically putting $3.6 million, almost $3.7 million into the renovation of the property. We're buying it at $15 million. We're putting a 3.7 renovation budget on it. Go back to the first part of the case study. Keep going. Okay, so just to give you an idea, this is an excellent, and this is going to answer the questions that we're asking before. Go to the top unit where it says, okay, again, same property, 324 units. They were asking $16.5 million. We came in and we're purchasing it at 15 million. So right off the bat, we're, we negotiated because we knew where our price needed to be. Okay. The rest of it is just some of the line items that we're going through, but this is kind of like the summary page. The important part, if you go to the bottom, you see where it says average annual return. So we're projecting that this property, we're going to be making, not only us, but our investors individually, they're going to get the pro rata share of 32% a year. Okay, that's a combination between the dividends and the exit, what we sell it for with the forced appreciation. So just to give you an idea, we're buying it for, just to give you simple numbers, we're buying it for 15 million. We're putting, let's just round up, say we're putting 4 million into it for the CapEx, which is the renovation budget. The rest is going to be closing costs and some other fees. We're going to be all into it for about a little over 20 million when it's all said and done. But we're projecting that on year 5, we're going to be selling it for anywhere between 42 to 47 million, depending on the cap rate that we sell at that point, without getting too technical. But if we're just looking at the purchase price and the sale price, we're purchasing at 15 and we're going to be selling at 42. That's almost 3 times, right? So that's where that 2.81x equity multiple that I was talking about earlier fits in. We're buying it at 15 and the plan is to sell it at 42. Think about that. That's almost a $30 million profit right there. Almost, just about. Minus what we're putting into it for expenses and everything else, right? And that's where our investors are able to benefit from that forced appreciation by your proportionate shares that you purchase as you enter into the opportunity. Go to the next one. And again, this just goes back, and this is just kind of a more detailed breakdown of all these numbers that I've gone over with you. And it's just mainly just meant to illustrate. Yeah, it is just meant to illustrate so you can see what goes into it. And I mean, again, we have an entire department that is solely dedicated on underwriting properties. And we have a whole system, we have a whole process where it has to go through certain layers or review. And then once we get to past a certain point, then we really go deep and really start to dig into the numbers. I mean, we have a whole system in place. And like I said, we have a full department dedicated to that alone. Think of it when you're analyzing stocks on the other side, if you have an analyst that's trying to pick out the winners, looking at the company's financials, their balance sheets and all that stuff. We're doing the exact same thing, but based on a hard asset. And we're making the decisions based on the numbers, what we're seeing from that property. And we're analyzing all of that. Go to the next one. And then again, this is actually our modeling out, like what we're saying, okay, we're going to make, X amount in year 1, X amount in year 2, year 3, year 4, and then year 5 on the sale. What I want to point out, if you look, go to year 3, you see where it's highlighted refinance? So in year 3, in this case study, a part of our business plan, which is the best part really, is that once we stabilize it, in other words, we're going to renovate all the units within the first 2 to 3 years. Once the units are renovated, we're increasing the rents on every single unit, 324 units. We're increasing the rents of every single unit by $500 per month. So that's an additional $500 times 324 times 12 for every year. Do that math. That alone is going to increase the revenue for the property, which in turn increases the net operating income, which in turn is what determines the increase of value, right? But then here's the best part. So we're projecting that in year 3, we're going to be able to refinance out of the construction loan that we have, which is like a bridge loan, into a permanent long-term, like Fannie, Freddie, low interest, full long-term loan. But we're going to have so much equity. Think about when you refinance your house and you take equity out for yourself or to pay back any expenses that you put into it, or into that exact same thing here. We're going to be able to refinance and actually pay back all of our investors. So let's say you invested 100, let's say you invested 500,000 with us. On year 1, year 2, you got your dividends. On year 3, we refinance, you get your $500,000 back. So now you have your original money back. You've already received 2 years or maybe 3 years of dividends. Now in year 4 and year 5, you still continue receiving dividends, but you already have your money over here, your original capital. So now it's basically, technically it's the definition of infinite return. By definition, that's what it is. If you ever heard of the term, it really does exist. It's not like a made up thing. It's infinite return because now you got your capital back. You have no money, your capital. You can take that money, invest it in the next project, and you're still collecting for 2 more years dividends with us. And when we sell it, you're getting your proportionate share of that close to $30 million that I was sharing with you guys about that in the increase in value. So then now you're going to cash that in too. And so when you average that out over the course of the 5 years, when you average it out over the whole 5 years, your dividends plus your value add equity shares, that's how you get an average over the life of the investment of 32. And that's actually conservative. We ran the numbers, we updated some figures, and it's actually a little bit higher. But again, this is just for educational purposes only. So as an example, it's like in this case, it's 32% return annualized. And so that's when, like, sometimes people say, well, no, that's too good to be true. We don't see those kind of returns. I mean, it's all here. And this is the type of returns that we see in real estate. I mean, honestly, we only get into a deal if we know that we can average in between 30 to 40 on average return on a deal. If it's 20% or less, we won't get into it. We find it too high risk. The margins are too low. And that's common. You talk to anybody in real estate that knows what they're doing, that is the standard. That is common. You want to be in that 35% range in returns, whether you're fixing and flipping a house on a single basis, or if you're doing something like this on a much larger scale. Yeah. So again, this is just more of our model. This is just been, I'm not trying to make you guys dizzy with all these numbers, but it's just to kind of show you. So it goes back, actually leave this here. So this is another summary. That's why if you notice, when you look at the model, year 4 and year 5, you're seeing infinity, right? The reason you see infinity there and the return numbers is, so go back actually to year 1. So year 1, we're making 11% return. Just go to the cash on cash. Just that part, where says 11. Okay, so you see this part. So this is what would be the cash on cash. So year 1, because remember, year 1, we're still stabilizing. We're making 11% that year. Year 2, now we've stabilized a lot of the units. We're able to increase the rents. We're making 18%. By year 3, we've stabilized the majority of the units. Pretty much all the units will be stabilized. Now we're making almost 20% for that year in cash on cash return. That's the same year we're refinanced. That's the same year we all get our money out, including us, the investors and us. So that means year 4 and year 5, it technically is infinite because we've already recouped, we've recapitalized ourselves. And then from there on out, then you have the exit. So that's basically in a nutshell. That's how when we look at a project. This is an example of what someone would make if they made a $500,000 investment.
And is that always your goal, to refinance and cash everyone out, or is that on a case-by-case basis?
Case-by-case basis. That's like ideal. That's ideal. In this case, this project literally checked off all the boxes. In some cases, maybe there's a partial refinance or a partial recapitalization. In other cases, we just have to stay in until the exit. In some cases, it might be a 7-year business plan. In this case, it's a 5, but in some it might be a 7. We've seen them as far as 10. That's a little too long for us. I like to the reason I like this deal so much, and the reason all of our investors like this deal so much, is because it's literally almost like a unicorn. Like it meets all the checks off all the boxes. The recapitalization in year 3, the exit in year 5, the fact that we can increase the rent by $500 per month per unit, and the strategy that we're using, we're able to do it pretty much right away versus having to gradually increase the rents little by little, where there's, to avoid payment shock. So there's a lot of different things that we're doing in this one particular project that it's a great project. So that's, and again, it's the actual current project that we're working on now, which is why we're using it as a case study. Now, like I said before, this is a 5-year commitment where it's a little bit of a bigger investment, but then we have other opportunities where it might be 1 year or less, where we're basically paying 18% return. It's what's called mezzanine debt, structured debt financing. It's a whole different thing, which I'll be happy to kind of present that structure as well at some other time. Obviously, we don't have the time for it here today, but again, there's multiple structures that we use to be able to, provide opportunities to as many people as possible. And that's basically it. So I'll wrap up with this. And honestly, again, I'd like to throw in some of my tidbits of really like my core values, honestly, and this is one of my favorite. So, the reason I like to educate and bring these type of opportunities and possibilities to people is, number one, I want everybody to see what's possible. Okay. And for me, one of the things that I always go by is that, as human beings, we want to see the evidence to make sure that something, you have to see it to believe it, right? Your mind requires that evidence to really expand your limiting beliefs, right? Like to eliminate your limiting beliefs, to believe that something is possible. So that's the top of the pyramid here, right? But, the next step is, and this comes from proximity and who you surround yourself with. If you see people that are really doing it and they see that it's working for them and it's possible for them, then, and you're around these people, right? That proximity, then you begin to believe that it's possible for you. Okay. But even if you believe it's possible, and even if you, deep down believe that it's possible for you, the only way that you'll be able to achieve it is once you ingrain into your belief system that you deserve it. And that's something that we all struggle with. Sometimes, we feel that, yeah, it's possible for them because they're doing this or because they deserve it. But we all have to believe that we deserve it. Once you believe that, once you believe it's possible, once you believe that it's possible for you and that you deserve it, the sky's the limit. And that's something that I work on, that I've always worked on in my personal life, and is the mindset aspect of it, which is what I'm saying now, where, I remember when I was terrified to buy my first single family investment, and now we're sitting here buying thousands of doors. And it's all having to do with how you, expand your limiting beliefs or eliminate your limiting beliefs.
But let's look at the questions.
Yeah, we'll look at the questions next. And then, sorry. No, that's fine. So, again, this was just another one of mine. I'll let you guys read it for yourself. But again, it's about legacy, and legacy starts with the choices we all make today. So just, definitely keep that in mind. Finish on the last slide so that anybody can. So I'm going to answer questions. I'm going to leave this slide up. This is our QR code for anybody that wants to find out more. Tony, I'm going to send, I think you guys already have this presentation. If you want to share it with everybody.
Yeah, that was one of the questions, if the recording would be available. So yeah, we'll send the follow-up email to everybody, and we'll include the recording and a copy to this presentation. And George also has a free school community, so we'll send links to all this stuff in a follow-up email. So this is an interesting question. It's kind of like a little bit of clickbait. So I heard you turned 1,000 into 100,000. Can we do the same? So I know you have a kind of your rags to riches story, how you started with $1,000. Obviously, I think there's when you say things like that, there's a lot of steps in between. But do you want to maybe break that down for everybody?
Yeah, for sure, for sure. So, 100. So again, like it's now literally a 9-figure portfolio. But I'll give you the short story of my first deal. So with my first deal, first of all, when I started the company, I had already been in real estate. I had been a lender, a correspondent lender. I was table funding my own deals. I've been involved in doing title. At that point, I was already doing loss mitigation, foreclosure defense, been involved in thousands of real estate transactions, but more in the traditional sense that we all think about with real estate. And what caught my attention was that as in my position at the firm, my job was to review all the purchase contracts that came in for our distressed clients that were selling, short sales and all that kind of stuff. And I kept seeing that some of the same buyers kept coming back. And I'm like, how are these guys buying 2, 3, 4 properties in the same month? I'm seeing the same buyers and they're all cash offers. And so I would start talking to them and really picking their brain. And it would have been really easy for me to say, oh, I'm a lender. Oh, I'm, loss mitigation. I'm a lawyer. I have my Juris Doctorate. I've been involved in all these, hundreds of thousands of transactions and just kind of been closed off. But I came in with an open mind and I started learning different strategies. One of the first strategies I learned was a strategy called real estate wholesaling, where you can literally buy and sell real estate with no credit and no money. It really is a thing. It's not like, something fake. But I learned how to do it. I learned how to do it the right way, how to do it legally, ethically, and correctly. And my very first deal, I literally applied this strategy. And the reason I say I started with $1,000 is because I literally took $1,000. I put the property under contract. I did the analysis. I learned how to do all the analysis. Same thing that we're doing with this property. It was a value add. I knew that I could sell it, that the property was worth a lot more if it got fixed up and someone else could fix it up and sell it. They would make all this money. I didn't really have all the money to do it. I didn't have the experience. I was afraid to do that, but I knew contracts. So I said, okay, I'll put it under contract. I'll put $1,000 deposit in escrow that's protected during my inspection period, right? So I'm not going to lose that money as long as I, either cancel or sell it before I lose my inspection period. And I found someone to buy the property for me for $20,000 more than what I had under contract. So I just literally just signed the contract to them on the closing date. I signed the contract to them. So I made my $20,000 spread. They bought the property. They went ahead, they fixed it up. And the property was already worth like an extra 40,000 more after it was fixed up, 50,000 more. I recently, a few years ago, this was back in 2015. A few years back, I went back and I looked at that property out of curiosity, and it almost more than doubled the price. So I don't remember if the same person that I sold it to still kept it or if they sold it at some point. But I went back and I kicked myself. I'm like, if I wouldn't have had the resources and the experience and maybe not the fear and the limited beliefs of doing it, maybe I could have made more than 20,000, right? But still, I made 1,020 in 3 weeks, by the way. And then I started learning more strategies and I started using what was called strategy stacking. And 20,000 turned to 40 into, I kept repeating the process. And I was making, if I made 20,000, I made 50, 70,000 on a wholesale like that. And then I started doing more like buying the properties and making the bigger returns. And then little by little, I started going to the smaller multifamilies and then to the larger multifamilies. And now even with the same strategy that I used on that first deal, we're doing that on a $10 million property that we're flipping for $15 million by simply just flipping the contract. So the same strategy I used at a $100,000 property where I made 20K, now I'm using the same strategy. I'm not even buying this property because it's a industrial, 90-acre industrial site. We don't do industrial, but I know contracts. So I look at it as a tool belt. So, when you have a tool belt, you need to have the right tool for the job, right? And that's what these strategies are. You can't take a hammer where you need a screwdriver. So you have to know where to apply it. And that's what I've become really adapted in the space of real estate, is how to use different strategies for different opportunities and not leave money on the table. I couldn't even see it said, I don't develop industrial, I don't build warehouses, but I'm like, well, we know how to analyze a deal. We know how to put together the contract. We know how to market it, how to move it. And if we can make $2, $3, $4 million spread by simply signing a contract, why wouldn't we? And that's how you make compound interest, but you compound knowledge, you compound effort. And yeah, that's how you turn $1,000 into a 9-figure portfolio.
Wow. And is that still a strategy that you think is viable today?
100%.
Aren't there some laws and regulations, like hasn't the market changed a lot since?
Well, it does vary state by state, but at the end of the day, we're still dealing with fundamental contract law, which is where you have, as long as you have, without getting into the technicalities of it, there's such a thing called the merger doctrine. So when you have a property, what's illegal is when people don't do it right, when they don't follow the right steps, when they don't have the right disclosures, when they're not doing the right funding methods. And then yes, there's a lot of ways that you could do it wrong where it's illegal. But as long as you educate yourself on how to do it right, that's why I always said you learn how to do it legally, ethically, transparently, and correctly, you could get it done. And there's nothing illegal about it. It's just standard contract doctrine law. But you got to know how to do it. And that's where a lot of people get into trouble. They watch 1 or 2 YouTube videos and they think they can do it. And then, they make a mistake because they didn't know how to do it. They didn't follow an attorney's advice, or they didn't, really assess themselves from, around the right people. And then obviously did the wrong way to do it. So, but it's not that it's illegal, it's that people that don't do it right are doing it illegally.
Got it. Cool. Well, George, I want to thank you again for taking the time. We're going to send out, like I said, a mass email with all the links, the link to this recording and all the other links that you shared. If people want to get a hold of you, what's the...
Yeah, I'll put up real quick just for like a couple minutes, like for like 1 minute, whoever wants to do the QR code again. That way you can take a screenshot of it.
Yeah, and what's the best email if people want to like get a hold of you and learn more?
So let's do it. It's an email that's there, which is our marketing email. It'll go to our marketing department.
Yeah, that it goes to your team and they can handle
it. It
goes
to my team. So it's MKTG, so they abbreviated for marketing, MKTG at KPI-capital.com. So you can put it in the chat. Yeah, put it in the chat right now, just so that you can just copy and paste it there.
Cool.
Yeah, we just put it from
Perfect. I reshared it. Yeah. Okay, great. And then like I said, we'll send out a nice follow-up email with all the notes and the link to the recording and everything.
Yeah.
But I want to thank everybody for tuning in on a Wednesday evening to learn and expand. And Jorge, I want to thank you for being so generous with your time. And if anyone's in the Miami area, come hang out with us. We have this event coming up on the 30th.
Yeah, it's going to be at a beautiful venue in Brickell. So we're going to be sending out all the details.
It's a private event. It's going to be a group of, it's kind of a mixture between George's community at KPI Capital and the Latino Wall Street community. So it'll be a lot of fun. And so look out for your email. Invite only. You guys will get the email once it's ready. But mark your calendars, October 30th in Miami. It'll be a lot of fun. I believe it starts at 7, right? 7 p.m.
Yeah, 7 p.m.
7 p.m. in Brickell.
It's going to be, a lot of value, a lot of information, some hors d'oeuvres, some drinks, some music. So we're going to have a good time.
Absolutely. All right, looking forward to it. Well, thank you, George. Thank you, team.
Everyone.
And we'll see you guys in Miami in the next 2 weeks.
Sounds good. We'll see you all.
Good night.
Thank you, everyone.
Good night, guys. Blessings.